Hey everybody, Sam Saggers here. I want to talk you through some strategy around some long-term off the plan. Of course, long-term off the plan allows you time for the market to actually grow. It's the concept of buying off the plan. It allows you into the pre-construction real estate market, allows time to mature, and of course for you, this can lead to fantastic results. If growth happens along the way or a little bit of inflation, your investment's well on its way to being worth a lot more than what it is today. So I want to talk you through long-term off the plan. What we look for long-term off the plan is a minimum of 3 years from the day you get involved to the day you settle. So how do we look at it? Time frame wise, 3 years, but make sure your property matures nicely. You need to actually hold it for at least another 2 years after your investment settles. So for 2019, that would take us up to 2024. Can you imagine what your real estate will be worth in 2024? Fast forward 3 years from 2019, 2022, why I like long-term off the plan. If the market moves and if inflation happens, valuers are more likely to end on the end value of real estate into the future if it's at least a minimum of 3 years. So pretty cool. So we can also, during our 3-year period, get capital growth, but we can also control something as well known as savings. So we can put some money aside. We're also going to get rental growth because inflation in rental growth right now within Victoria is really high. There's very low supply. You all know there's a bit of a credit crunch on right now. That is really stop the supply chain. Over and above that, risk-wise, Victoria is such an awesome marketplace to buy long-term off the plan. Why? Well, if you're struggling, you can actually nominate your contract to someone else. They can take over your contract and really settle on your behalf. It's a great tool, only available in Victoria. Let's take this concept a little bit further. Now, in Melbourne, right now, unbelievable price points. You can buy within a 5-kilometre radius of the CBD of Melbourne, ridiculously low price points for circa $400,000 for a quality property. So you can imagine that $400,000 property, we're putting a $40,000 deposit. When you buy off the plan, you need a 10% deposit. So if we activated our savings plan over a 3-year period, if we were to save $100 a week, which isn't hard, everyone can do it, we'll end up with $15,600 of saving. We're going to use that money a bit later. If the market was to grow just above inflation, inflation usually sits around 2 or 3%. We're talking 5% growth, very low, moderate level of growth. If we see that compounding growth occur over a 3-year period, our $400,000 property has gained $63,000 on completion. It's a nice amount of money, not a huge amount of money, but a great amount of money for the purposes of lending, for the purposes of controlling your portfolio. I'm going to explain a little bit later. Rental growth, let's imagine that was also circa 5%. Some indications at the moment are much higher than that, but let's be conservative at 5% growth. A $380 a week rent today will jump out for settlement at around $430 per week. Pretty cool, right? Of course, the 2 years after we own the real estate, we're going to get some great tax benefits, circa $15,000. But let's look at the LVR position. Let's find out our financial health. Right now, if we buy a property, we not only want to make money, but we want to end up financially sound. And that's why I love long-term off the plan. So our $400,000 investment, we actually needed to pay a $40,000 deposit, which takes us down to $360,000. We've saved $15,600, which takes us down to $344,400. That is our debt. Our new value, though, of our real estate is coming in at $463,000 based on a conservative level of growth at 5%. So our new LVR, our debt versus new value, puts our asset at 74% LVR. Pretty cool. What that is going to mean, it's going to mean that banks are going to like talking to you again. It's going to mean you're going to not stop building your portfolio. From an investment point of view, you're looking very, very healthy on paper. The other thing is your rent on your debt is now 6.5%. That, of course, is fantastic for your serviceability. So a great strategy to propel forward and end up, particularly on paper, looking very mathematically clean to banks and lenders, but also making some money along the way. A great investment strategy.